Introduction to short call options. A short call option represents a bearish to neutral position. It is used when there is an expectation that the underlying stock will remain below the strike price or decline slightly. The seller of the call is positioning to collect a premium, with the goal of the option expiring worthless. For this illustration, all price movements in the underlying stock are assumed to occur within a single day. This isolates price action and removes the effects of time decay, meaning theta is not a factor in this example. The impact of delta is also minimized to maintain focus strictly on price movement. This example uses XYZ stock to demonstrate how a short call option works within a profit and loss framework. The current stock price is $48. A call option is sold with a strike price of $50, and a $2 premium is collected, which establishes a break-even level at $52. At the current price of $48, the position is profitable. The stock remains below the $50 strike price, meaning the option has no intrinsic value, and the full $2 premium is retained as profit. For the position to remain profitable, the stock must stay below $52. Any movement above this level results in losses. At a stock price of $49, the position remains profitable. Although the price has moved closer to the $50 strike, the option is still out of the money and has no intrinsic value. The seller retains the full $2 premium, resulting in a net profit of $2. This reinforces that as long as the stock stays below the strike price, the short call position benefits. The trade remains profitable anywhere below the break-even level of $52, with maximum profit achieved if the option expires worthless. At a stock price of $50, the option reaches its strike price and is considered at the money. At this level, the call option still has no intrinsic value, because the stock price is equal to the strike price, not above it. For the seller, the full $2 premium collected is retained, resulting in a net profit of $2. This highlights that even when the stock reaches the strike price, the short call position remains profitable. The trade continues to benefit as long as the stock stays at or below the strike price, with profitability maintained up to the break-even point of $52. At a stock price of $51, the option is now in the money and begins to gain intrinsic value. The call option is worth $1 because the stock price is $1 above the $50 strike price. For the seller, this results in a partial loss. After collecting the $2 premium, the $1 intrinsic value reduces the position to a net profit of $1. This shows that while the position remains profitable, gains are beginning to erode as the stock moves above the strike price. The trade will continue to lose value as the stock approaches the break-even level of $52. At a stock price of $52, the option reaches its break-even point. The call option now has $2 of intrinsic value, because the stock is $2 above the $50 strike price. For the seller, this fully offsets the $2 premium that was collected, bringing the position to neither a profit nor a loss. At this level, the trade has given back all initial gains, and any additional increase in the stock price beyond $52 will result in net losses. At a stock price of $53 and beyond, the position results in increasing losses. The call option now has $3 of intrinsic value, which exceeds the $2 premium that was originally collected, resulting in a net loss of $1. For every additional $1 increase in the stock price, the loss continues to grow accordingly. This highlights the key risk of a short call position. Loss potential is theoretically unlimited as the stock price rises. As the option moves further in the money, the seller is exposed to greater losses, since the obligation to sell the underlying stock at the $50 strike becomes increasingly unfavorable relative to the market price. Conclusion: this example illustrates how a short call option transitions from profit to loss as the stock price moves higher, with the break-even point acting as the key threshold. The position performs best when the stock remains at or below the strike price, allowing the seller to retain the full premium. As the stock rises above the break-even level, losses begin to increase. It is important to note that this simplified scenario assumes all price movement occurs within a single day, intentionally excluding factors such as theta, time decay, and delta, price sensitivity. These elements play a significant role in real-world options pricing, but have been removed here to focus strictly on the relationship between stock price and option payoff.